This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Well, at the end of the previous session there, we were talking about takeovers and dealing with share-for-share exchanges. And we've gone through the theory, which hopefully you've revised through in relation to the basic examples I illustrated the issues with. And now, together, we can have a go at example 4. Right, what are they asking us to do? To calculate the capital gain arising on the disposal in January 2016. Right, we discover when you read through the information that in January 2016, Mark sold all his holding of ordinary shares in Gold Limited for £35,000. So we're thinking, well, this is easy enough. Calculate the gain on the disposal in January 16, sale proceeds £35,000, and we sold all of the holding of ordinary shares, so we're going to have no problem in working out what the cost will be. It'll be just the total cost. But then we start to read the further information in the question. In May 2012, Mark had purchased 4,000 ordinary shares in, what's this? Silver Limited there. But we're selling shares now in Gold Limited. What's going on? So we bought 4,000 ordinary shares in Silver Limited for £12,000. In June 2015, Silver Limited was taken over by Gold Limited, and Mark received 2 ordinary shares. Let's just make sure again we can see that okay. Received 2 ordinary shares and 1 preference share in Gold Limited for each ordinary share in silver. So in relation to the 4,000 ordinary shares that Mark owned in Silver Limited, as a result of the takeover by Gold, Mark will receive 2 ordinary shares for each of the 4,000 ordinary shares held in silver, and will get also 1 preference share in gold, and that will allow us to work out how many ordinary shares and how many preference shares you would now, or Mark would then have received in Gold Limited. But of course we need to know the market values of those shares, and we're told immediately after the takeover the ordinary shares in Gold Limited were valued at £5 and the preference shares in gold valued at £2. So, to be able to deal with this disposal of the ordinary shares in gold, we've got to go back and deal with that takeover. Now, we know that at the time of the takeover, Mark owned 4,000 ordinary shares in silver, costing £12,000. What we then need to do is to divide that £12,000 cost of the silver shares between the 2 types of share then received from gold, i.e. the ordinary shares and the preference shares. And all we need here is one simple little working. We have 2 columns on the right hand side of the page to record open market value to begin with, and then do our cost allocation. Now bear with me here. Right, what did we receive from gold? Firstly, we received some ordinary shares. How many ordinary shares did we receive? We had, Mark purchased, remember, 4,000 ordinary shares in silver, and for each of those 4,000 ordinary shares, receives 2 ordinary shares in gold. So in terms of ordinary shares acquired in gold, 4,000 times 2, 8,000 shares. What were they then valued at that date? £5 per share. So 4,000 at 2, 8,000 shares, times 5. That means we received at the time of takeover £40,000 worth of ordinary shares in Gold Limited. 40,000 in gold there. We also received some preference shares. Now, what was the basis on the preference share receipt? Again, for the 4,000 ordinary shares in silver, we received, let's look at it again, one preference share. 4,000 times 1. And what were they valued at the time of takeover? £2 per share. 4,000 times 2, 8,000. Pardon me. Oh dear. So at the time of takeover, we received £48,000 worth of shares within Gold Limited. That divided between £40,000 worth of ordinary and then £8,000 worth of preference shares. Oh, pardon me again. Hopefully we'll survive to the end of this lecture. Okay, now why do we need to know that information? Because it is on the basis of those market values that we then take, well, I've ringed it enough times there, but we then take the cost of the Silver Limited shares, which was £12,000, and divide that cost between the ordinary and the preference shares now held within Gold Limited. That cost of £12,000 will become, in part, the base cost of the ordinary shares and the base cost of the preference shares held within Gold Limited. The basis, we use these market values. So, get your calculators out. You now need to split that 12,000 according to those market values. So 40,000 over 48,000, 40/48ths of that 12 belong to the ordinary shares. Put that through the calculator and hopefully you get that to be £10,000. 8,000 out of the 48, 8/48ths of the 12, that will be the balance of £2,000 of cost, will be allocated to the preference shares. So you now know that going forward, the ordinary shares in gold will be deemed to have cost £10,000 and the preference shares in gold will be deemed to have cost £2,000. At the time of takeover, no gain crystallised. This is purely a paper for paper, a share for share transfer. The only thing that's made it interesting is that we've got two different types of shares in the takeover company in gold, they being ordinary shares and preference shares here. So look at what we've done, list out the market values of what you receive and use those market values to divide out the original shareholdings cost. That was the £12,000 cost of the shares in Silver Limited. Once you've got that, we can then move on and deal with any future disposal of either the ordinary shares, which is what we're told about here, or indeed, if necessary, the preference shares. What has happened in January 16, Mark sold all of his holding of ordinary shares in Gold Limited for £35,000. So you now show your gains calculation. It would be simple enough. Sales proceeds, as we said before, £35,000. And what do you now know to be the cost of those shares? There is your cost of your ordinaries. Oops, what happened there? There it is again, £10,000. Had you sold the preference shares, then you'd have had a cost of £2,000 that would be attributed to them. So we can deal with the share for share transfer at the time of takeover. No gains crystallise, paper for paper, share for share transfer. The new shares take the cost of the old shares. But where you receive two types of security, like this ordinary and preference, we must divide out the old share cost, here £12,000, proportionate to the market values of the new shares that have just been issued to you. Once you know those costs, job done, you can then work out any future gain. Okay, now that sorts out how we deal with a pure share for share takeover. So no gain crystallised at the time of takeover, and the only question is, how do you derive the cost for your new shareholdings in the new takeover company? We've done it, we're there. Let's go back though to your notes from last time and looking at those notes on takeovers. Now we've just said that share for share relief, that treatment is automatic. However, although it automatically applies, the shareholders can elect for the event to be treated as a disposal for CGT purposes. You can actually elect to disapply the share-for-share relief and actually choose to crystallise the gain on the old shares. Again, in the example we've just done, that would have been on Silver Limited. You can crystallise the gain at that point in time. Now, it would seem odd. Why would you choose to crystallise a gain and be taxed on a gain sooner rather than later? That would appear in essence to make no sense. If I'm going to be taxed on a gain, let that gain be taxed later rather than sooner. So why disapply the deferral? Why choose not to take that deferral? Well, the reason for that is, although I would rather be taxed later, that assumes that when I am taxed later, that I would be taxed at the same tax rate. Now, although we haven't seen it yet, it is the, in fact, next thing to do in our next chapter. We need to look at various reliefs. There are several of them. Next chapter, I'll warn you, is it's a big chapter, that one. But one of those that we have mentioned is something called entrepreneur's relief, which isn't in fact a relief, it's a tax rate. And it's a very much better tax rate than the normal CGT rates that we witnessed last time, those rates being 18% and 28%, but is a rate of 10%. So the reason why you might disapply the deferral and choose to crystallise the gain on Silver Limited at the time of takeover would in fact be because that gain may qualify for entrepreneur's relief, and you don't automatically get entrepreneur's relief, you have to qualify for it. So maybe the shares in Silver do qualify, so that gain, though taxed sooner, would be taxed at 10%, whereas you are a higher rate taxpayer. And when you acquire your gold shares, maybe the shareholding you acquire in them is such that you don't actually rank for the entrepreneur's relief. And on that basis, let me be taxed sooner on a gain at 10% rather than later on a gain at 28%. But we'll talk more of that once we've dealt with entrepreneur's relief. But that's the basic planning idea. Now, you will only have to have a very basic understanding of that. You're not going to get any complex problems at this level. Again, that will await you if you choose to go on to do it at P6. Coming back to the time of takeover, though, and what is probably more likely than anything else, is rather than receiving a mix of different types of share, say ordinary and preference shares, is that what you receive is also a mix, but it's a mix of shares and cash. So if at takeover some cash is received, what do we do then? Well, if you receive cash, then of course there is an immediate gain crystallizing, and therefore we are likely to have to be paying tax on any such gain that arises at this point. We won't be able to defer. The share-for-share relief rules will not apply there. So a capital gain needs to be calculated at the time of takeover for the cash element received. Now, in fact, this is no more difficult than what we have just done in terms of the example 4. All it will require is exactly the same working as we just did. It is just that cash will be in there rather than one of those types of share. So let's move on to and look at example 5. And if I could ask you there just to have a little read through example 5 and familiarise yourself with that information, please. Okay, so example 5. Again, here we use information we had in example 4, but this time we'll assume that at the time of takeover, Mark received, again, 2 Gold Limited ordinary shares, once again valued at £5 each. But instead of 1 preference share worth £2, actually got £2 cash for each share held in Silver Limited. Now, all we've got to do is to repeat the exact same working as we had before. We list out the open market value of what we receive at the time of takeover. which is now a combination of shares, their ordinary shares, and also cash. And we will then use those market values as a basis for dividing out the cost of the original shareholding. Now again, look back, what was the original cost of the shares in Silver Limited? That original share cost was £12,000. So let's work out those market values now. They're going to be the same numbers as we had before, but we had owned 4,000 shares in silver, we got 2 shares in gold, and those shares were then valued at £5. So that will, yet again, give us £40,000 worth of value of ordinary shares received in Gold Limited at the time of takeover. In terms of cash, for each share held, 4,000 shares times £2 cash. That therefore is £8,000. The only difference, this time it's cash, previously it was preference shares. Total 48,000. Use those market values to divide out that cost on a proportionate basis. So 40/48 of the 12, i.e. 10,000, yet again belongs to the ordinary shares, and the remaining 8/48, the remaining 2,000 there, of cost belongs to the cash. And the only difference now is that at the time of takeover, we only get the share for share rules in relation to the shares that you have received. Those now 8,000 shares that you've got in Gold Limited will be deemed again to have cost £10,000. But this time you receive cash, and where you receive cash there is a gain to calculate. How do we calculate that gain? Based now on you've received cash of £8,000 and the relevant cost attributable to that cash received is £2,000. That is the basis of the gain. Proceeds 8, cost 2 equals a gain of 6,000. So you'd have an immediate gain crystallising at the time of takeover of £6,000 on your ordinary shares in gold now received, share for share relief, and they would be deemed, as we said, to have a cost of £10,000 for purposes of dealing with any future disposal. So it's exactly the same working, except now that in relation to cash, an immediate gain arises, and you've got that gain, the basis of it, in your working. There is the 8,000 cash received, there is the £2,000 of cost now attributable to it. You extract it, of course, from this working and put it in a separate gains calculation, and that would give you the gain of £6,000 there. Okay, check that out with the answer in the back of the notes. Make sure that you're happy with that. And then next time we'll look at the last of the current chapters on capital gains, dealing with CGT for individuals, and deal with the various reliefs that are available to individuals in various circumstances. Those reliefs will either serve to reduce a gain permanently, i.e. they would exempt a gain from any chargeability now or in the future, or as most of them do, they tend to defer gains. So they won't tax you now, but they will tax you in the future. It's a deferral. The only other type of relief, which is neither of those two things, is entrepreneurs' relief, the one that we've mentioned more than any other, in fact possibly the only relief that we have mentioned. An entrepreneur's relief is quite simply a tax rate. It doesn't defer, it doesn't exempt any gains, it's merely a tax rate. But it's a rather beneficial tax rate as compared to the other alternatives. It's a 10% tax rate rather than 18, or more likely for the sort of person we'll be dealing with, i.e. a higher rate taxpayer. That tax rate for CGT would otherwise be 28%. Very much nicer, therefore, if we can qualify for entrepreneurs' relief and then only pay tax on a gain at 10 rather than at 28%. But all of that awaits us in our next lecture together.